Okay, welcome back, everybody. Today is Monday. Hope everyone had a good weekend. We're still working in chapter 5. We're already through the content. Once again, we covered the slides last week. Did some illustrative examples for the capital projects fund, some entries we'd see in that. Today, we're going to get into doing some illustrative entries for the debt service fund and for the permanent fund. And then we'll look over the financial statements that are a result of the entries that we've seen from chapter 4 and chapter 5, which is just the five governmental funds that we've went over. So a result of all the entries we went over is going to be what populates or what ultimately builds the presentation of the balance sheet and the statement of revenues, expenditures, and changes in fund balance. So we'll go ahead and just get started from that right there. Let me see here. Apologize, I thought I had this pulled up already. So let's start out by just talking about the debt service fund. So we know that the debt service fund is there to service debt for the government, right? That just the general debt that's outstanding for the government. What two components are we concerned about that fall within the debt service fund?
Principal and interest.
Principal and interest. So we know when we make a debt service payment, it's going to either be applied to principal or interest on the note. With the debt service fund, we know that the proceeds coming into it usually come from the general fund transfers, but it could also be from accrued interest, from a premium on bonds that we issue for capital projects, or residual equity from a capital projects fund. So that's transfers that could come from the capital projects from those three sources. So let's just get into this debt service fund. We know that it uses the modified accrual basis of accounting, so focus with the current financial resource measurement focus. With the debt service fund, what is the difference when the government recognizes an expenditure? What is the difference between the debt service fund or the other governmental funds?
Debt service fund, it's when it's due.
When the interest is due, right? When the interest in principal is due, as opposed to when the liability is incurred, right? So that's the difference between recognizing the expenditure. That's the exception to the modified accrual basis of when a liability is, or when an expenditure is incurred. We know that the debt service fund can act as a sinking fund, if you recall, when we deal with serial bonds and with serial bonds and with deferred serial bonds. Remember, or with term bonds. I'm sorry, term bonds and deferred serial bonds. It acts as a sinking fund. What is the difference between a term bond and a serial bond?
The term's just for one term and a serial.
Right. So on a term bond, all that payment is due at the end of at maturity, right? At one term, at the end of the term. Interest can be paid throughout the life of the bond, or it could be paid at the end, either or. Serial bonds, it's due in installments, right, throughout different series of payments throughout the note. Deferred serial payments is obviously the principal payments start becoming due usually to a year or later beyond, so that the government can start bringing in some revenues from property taxes, right? So that's the difference between term bonds and serial bonds and deferred serial bonds. So just know that in the case of term bonds and deferred serial bonds, it acts as a sinking fund. Sinking fund is what we're just putting money in there. We're investing it in some investments and using, remember, amortization techniques and present value techniques to determine the amount of money we also have to put in there with what the earning is. So we know the different uses of the debt service fund. So now let's get into an illustrative case here. Let me see here. Let's just see where I'm at on these pictures. So, Okay, so now let's get into an illustrative case. It's dealing with regular serial bonds. So I'm gonna once again. This is directly from chapter 5 out of the book. I don't know if everyone's read it or not. Whether they have or haven't, I still want to go over it as we have been. I think this is really good practice, just showing some examples we expect to see and just talking about them. So once again, this is the debt service fund dealing with interest concerning a regular serial bond. So just bear with me. I'm going to do a little bit of reading here from the book. So it says accounting for regular serial bonds is illustrated by a debt service fund created to pay principal and interest for the fire station project for the village of Riverside that was discussed earlier in this chapter. Recall that early in 2020, the Village Council of the Village of Riverside authorized an issue of 1.2 million bonds with 8% tax supported on those bonds, right? So we remember that. At the time of authorization, no formal entry is required in the Capital Projects Fund. Remember, we said at the time of authorization we don't have to. Just because it's authorized doesn't mean that it's actually going to happen. Remember, it's actually once it's been issued. At that time, a memorandum entry may be made in the Capital Projects Fund and a provision made to account for debt service of the new debt issued in a debt service fund. So we just need a memorandum entry at that point, right, when it's authorized. So assume that the bonds in this example are dated January 2nd, 2020, that interest payment dates are June 30th and December 31st, and that the first of 10 equal annual principal payments will be on December 31st, 2020. So the bonds were sold at a premium of $12,000, if we recall from last class, and was recorded in the Capital Projects Fund. It was entry 8A earlier in the chapter. The premium was transferred to the debt service fund. Remember when we got that premium on the bonds, what do? We have to transfer it, right? Because remember, premium, interest, and residual equity from the capital project is sent where?
Debt service.
Right. So now here's that entry we're seeing. So this is what the debt service fund would have done when the capital projects fund transferred that $12,000 premium. Then the debt service fund made the entry. They debited cash because they're receiving it. The asset, it's going up, $12,000. Credited other financing sources, transfers in for $12,000. Right? Simple enough. We know that. Okay, while GASB standards do not require the reporting of the budget actual schedule for debt service funds, prudence would indicate internal budgetary planning. So now assume the $12,000 amount was known at the time of budgetary planning. So the $12,000 premium is what we're talking about, right? So assume it was known at the time of budgetary planning. The following would reflect the debt service needs related to this project. So we're talking about this project, right, that we discussed last class. So let's back up a little bit. Remember, it says assume that the bonds in this example are dated January 2nd, 2020, okay? That's the date. And that we have interest payment dates are June 30th and December 31st, right? And then we have the first of 10 equal annual principal payments on December 31st, 2020. Well, remember the bonds were for $12 million, right? Or, 1.2 million, I'm sorry. Not 12 million, I'm sorry, 1.2 million. And it's an 8% interest, right? And the date that they were issued was January 2nd, 2020. Well, we know we have interest payment dates on June 30th and December 31st, right? So they were issued January 2nd. So we have a semi-annual interest payment on June 30th of $48,000. We get that from taking the 1.2 million times 0.08, the interest rate, times 6 divided by 12 because it had been outstanding 6 months, right? So there's $48,000. And just so everyone knows, this breakdown is on page 127 of chapter 5 of what I'm going over, just if you need to see the visual. Next, we have another semi-annual interest, it says, due on December 31st. So once again, it's for $48,000. Same math. 1.2 times 0.08, which is the interest rate, times 6 divided by 12, which is the time period, the months out of the year that it's been outstanding. So that's the interest. Then recall that it says on December 31st, we have the first of 10 equal annual principal payments. So that's going to be the 120,000, which is the 1.2 million divided by 10, right? Because that's the principal. 10 payments equal 1.2 million divided by 10, $120,000. So the total cash needed is 216,000. The 120,000 from the principal plus the two $48,000 interest payments gives us 216, right? And then we have to factor in the premium of 12,000. So we less the premium of 12,000. So the cash needed net for 2020 is 204,000 for the debt service fund. Makes sense because we know we have those interest payments, right? The 248,000s, the principal of 120, take away the premium, it leaves us of 204,000. So that's how we go about using those techniques within the debt service fund of seeing what interest is to know how much money we have to put in. So like I said, once again, the breakdown of getting that 204 for this journal entry is right above the journal entry on page 127 if someone needs to actually see the math that I just described. But I think it's pretty simple from what we just did. We just basically applied the interest payments, the principal payment, and then just backed out the premium, right? So assume cash was transferred from the general fund in the amount of 204,000. Because remember, cash a lot of times is transferred from the general fund, the most common thing, right? So once we, as the leaders of our government, determine that we need 204,000 for the year 2020 to service the debt for that in relation to that 1.2 8% interest bonds that we sent out, we needed 204,000. So when the debt service fund receives that money from the general fund, they're going to debit cash, the asset of 204,000, because it's going up, right? Credit other financing sources transfers in of 204,000. So same song and dance here with the entry, right? I just wanted to go through the process of how we determine the amount of money the general fund actually needed to transfer over, right? Pretty simple, right? Okay, I'm going to do a little more reading, so just bear with me. Organizations such as banks or trust companies act as fiscal agents for commercial businesses or for governments. In the case of commercial businesses, fiscal agents commonly are responsible for making dividend payments to shareholders of record. So for business, we'll use a lot of times like these big Fortune 500 companies or public companies will use fiscal agents, and they'll put once dividends are declared, they'll put that money, with that agent, and then that agent's can actually pay the money, not the actual corporation itself. And that's just really just because it helps just keep it like a segregation of duties, pretty much. It kind of just that's what they do. You do this, we'll do this, and so that way they just keeps up with it as an agent, right, or a trust. Okay. In the case of state and local governments, fiscal agents receive cash from governments with outstanding bonds and distribute interest and principal payments to bondholders, right? So we know the government's actually borrowing money because when we issue a bond to the citizens, then in essence, then we get the money, right? So what it's saying is the government has these fiscal agents that are actually going to pay back these bondholders, right? So when a government uses a fiscal agent for this purpose, the government first records its payment to the agent as cash with fiscal agent and then records debt service expenditures for any interest or principal that is due, okay? So now let's assume that the village paid $48,000 to a local bank on June 30th to make the first interest payment, okay? So we know the interest payment was $48,000, right? Because it was the 1.2 times the 0.08 times 6 divided by 12. So there's that number, that's that figure coming back for us here. So once again, the village paid the bank $48,000, right, for this payment for the bond. So let's just see here, 20A, that's the first thing. So remember, the first thing we do is we give the money to the agent, right? So we need to account for that money leaving, right? So how do we do that? First thing we do is we debit cash with fiscal agent for $48,000 and then credit cash, right? Because we just gave money to the bank. But it's still our money, right? Technically, because we're holding on, we're just switching who's holding it, right? So it's still showing cash with fiscal agent. It's just telling where the cash is. And then obviously cash is going out, right? Next, we need to set up the expenditure for what it actually is. So now we're noticing the expenditure. So now once this entry is made, now that money is actually being held because we've incurred the liability. So expenditures, bond interest, right? Because that's what's becoming due, right? And then matured interest payable, 48,000. So now we've set up a liability, right? Because it's due, right, within this fund. So that's why we recorded that expenditure, bond interest, because it's due now, right? So once again, first thing we have to, if we're dealing with a bank as a trustee, we're giving them the money to the bank. So the first thing is we need to give the cash to the bank. Debit cash with fiscal agent, credit cash. The money's going out, but we still are accounting for it, where the money's being accounted for, who's holding it. Then we set up the expenditure because the interest is due, bond interest for 48,000, and matured interest payable. So now that's payable, right? So next, let's look at the next thing. So when the fiscal agent reports that checks have been issued to all bondholders, the government is going to make the following entry. So at this point, we're going to debit matured interest payable that we just set up as a credit, and then credit cash with fiscal agent of 48,000. So what does this entry accomplish right here from the previous entry?
Well, this gets rid of our liability, and we show that the cash is no longer there.
The cash is no longer in the agent's hand, that he actually paid the liability, right? Because the first one, we just showed that we put the cash with the agent by debiting cash with the agent, crediting cash. Cash left us, but we told where it was at. Then we set the expenditure up because interest was due, right? Remember, that's the exception. It's due. So we incurred the expenditure for the same amount, and then we credited the matured interest payable. So you're exactly right. Here, once the bank notified us, hey, we made that payment. So now we make our adjustment on our books. Okay, we no longer have interest payable because the bank paid it. Debit that, it reduces our liability, and then credit cash with fiscal agent. That means the 48,000 has left the fiscal agent's custody. Pretty simple, right? Okay, now let's on December 31st, the next interest payment of 48,000 is due. Remember, we have that next interest payment we determined because it's the 1.2 for the face value of the bonds times the 0.08, which is the 8% bearing interest, times the 6 divided by 12, which is the 6 months that it's outstanding with outside of the year. So there's that 48,000 interest payment again, the second one that's due on December 31st that we mentioned earlier. Also on that date, a principal payment of 120,000 is due. Remember, we have the equal installment payments of principal of 10 equal payments. So the 1.2 million divided by 10 gives us the 120,000. So the debt service fund pays the 168,000 to the local bank for payment and records the expenditures and liabilities for principal and interest. So once again, we're using this agent. The bank is our agent, right? So we know we have 48,000 of interest due and 120,000 of principal, right? Okay, so the first thing it says we're doing, right, we're dealing with an agent. So what do we want to do? We want to give them the money, right? So remember, it's the $48,000 on interest, 120 principal, so that makes up 168,000, and we're giving cash to the bank at our agent. So we need to debit cash with fiscal agent, credit cash, right? So what did that entry accomplish?
We're giving our cash to the bank.
Right. Next, as soon as we do that, we have to also set up our expenditure, right? Because why are we setting up an expenditure at this point?
Well, we're also setting up the liability, and it's.
But why? But the liability. We're also setting up the liability, but the liability is what?
It's the bonds.
It's due, right? It's due. Sorry, I'm just trying to hammer in that due, just bringing that point home, just so you know. So we're setting up the expenditure because the bond principal and interest is due. Because remember, we're in that debt service fund. It's not when the liability is incurred, which it really is. It's still incurred because it's due, but it's just when it's due. That's just the way that GASB has it stated. So here we see expenditures, bond principal, 120,000 because we know the principal's due. Expenditures, bond interest, we're incurring an expenditure for interest, 48,000. Credit, matured bonds payable of 120,000. Credit, matured interest payable of 48,000. So we've set up those liabilities, right? So once again, this right here, we have the interest payment due. We have a principal payment due that make up the 168. First thing we're doing, we're putting money with our agent. Debit cash with fiscal agent, showing the money's there. Give them the cash, money's going out the door. It's accredited. Next, because the interest and principal are due, we're incurring our expenditure within the debt service fund for both principal and interest, setting up the maturity or the liabilities that relate to those expenditures, right? So that's what we see here. Pretty simple, right? Same thing we just did. Now we just have principal tied in with interest, right? Okay, next, the bank reported that all payments had been made as of December 31st, 2020. So once again, we're going to debit matured bonds payable, debit matured interest payable, and credit cash with fiscal agent 168. And once again, this is accomplished. The fact that the matured bonds payable, the matured interest payable has been paid, because remember the agent told us he paid it. So we're going to reduce our liabilities of the interest and the principal payable, and then we're going to credit the cash with fiscal agent because he's no longer holding it. So it's going to reduce the money he's holding. Makes sense, right? Not bad. Okay. So it says, it should be noted that if principal and or interest payment dates were other than at the end of the fiscal year, for example, May 1st and November 1st, accruals would not be made in the debt service fund financial statements, okay? However, accruals for interest would be made when we're preparing the government-wide financial statements. So once again, debt service fund, so if the interest payments were not at year end, if say like it says here, one of them was on November 1st, so obviously the government would have a liability of accrued interest payable, right? But it's saying the debt service fund will not account for the accrual, okay? That's going to be in the government-wide. And I think we're catching on to that, right? The accrual will be in the government-wide. Entry 16 of the Capital Projects Fund illustration in this chapter reflected a transfer of $36,500 to the Debt Service Fund. This transfer of $36,500 represented the unused construction funds. Remember that, because remember what happens in the debt service or in the Capital Projects Fund. The premiums on bonds issued, any accrued interest, or any residual equity is going to be transferred to the debt service fund, right? So we know when we went over that example on last Friday about the Capital Projects Fund, they had that residual equity of $36,500 left over, and they transferred it to the debt service fund. So the corresponding entry that the debt service fund would have made is going to be a debit of cash of $36,500 because it's an asset, it's going up, and then credit other financing sources transfers in of $36,500 because they've received that money from the general fund. Pretty simple, right? Same song and dance. Okay, and now it says at year end, the debt service fund would reflect the following closing entries. So now it's at the end of the year for the debt service fund, and we have to make our closing entries. So we have a debit to other financing sources transfers in of $252,500. This is just the transfers that we had. This just happens to be the amount that it ended up being from the activity that we had from the other entries. We credit expenditures of bond principal. Remember, we had the expenditure during this year for bond principal of $120,000. We credited expenditures of bond interest of $96,000. Remember, $48,000 times 2. We had those two payments. That's the $96,000. And then the fund balance is going to be your $36,500. And notice that's the residual that was transferred from the Capital Projects Fund. So pretty simple. Same closing thing. It's just, remember, we only had two elements we were accounting for, right? The interest and principal. We can see we close those out because when you're accounting for it throughout the annual cycle period, normally it's a debit originally. So that's why we're crediting it here, right? We're closing the accounts. Other financing sources, the transfers in, once again, that's the sources in which it was coming in from the residual equity and the other transfers in from the premiums and other stuff. So makes sense on the closing, right? Just close them the same way we normally do with the relevant accounts. The financial statements are going to be displayed later on. We'll get through it, but first I want to get through some of the entries we would see in a permanent fund next, and then we'll look at some of the financial statements. First, actually, let me back up just a second. One more entry I want to go over in relation to the debt service. So remember, it changes if we use the deferred serial bonds or term bonds. Remember, the accounting changes a little bit for it, right? So we know that because it could actually be used as a sinking fund, right? The use of it could change, not the accounting, the actual use of it would change. But remember, there's also bond refundings. So pretty much what that means is a government wants to recall an old debt, right? They want to get it back. So how do they do that? They're going to issue new debt, and then with those proceeds, they're going to buy back the old debt. Why would a government want to do that? Maybe they want to get out of like bad debt covenants, like some just too strenuous or whatever debt covenants. Maybe they want to change the maturity date on it. Stuff of that sort. So it's important to know that governments a lot of times will do some bond refundings, and if they do that, then we can expect to see this type of an example for a journal entry. Let's say, assume a government wishes to refund debt with a new bond issue of $10 million. Okay, so we're going to reissue debt. We're going to refund debt with new bond issue of $10 million. The entries to record the replacement of the old debt with the new would be as follows. Okay, so remember we're going to reissue with we're going to refund the debt with a new issue of 10 million debt, right? So obviously, if we're going to issue new debt, we're going to receive 10 million in cash, right? So we're going to debit cash, asset going up, credit other financing sources, refunding of existing debt. Okay, so that's the 10 million. That's going to be our offsetting credit, and then debit other financing uses, refunding of existing debt. So we're just going to debit that credit we just established, credit cash because we're buying back the debt, right? Simple enough. Bring money in. Credit other financing sources, refunding of existing debt, debit that other financing uses, credit cash, and now all we've done is just refunded debt. Pretty simple, right? So that way, in case you would ever have to see that if it was refunding the debt, then we would have an idea of what we're looking at, right? Makes sense if we want to cancel all debt. Why would governments want to do this? Because remember, maybe bad debt covenants, they want to get out of that, change maturity date, or just whatever their reason might be. So now it's pretty good on entries for a debt service fund. Not bad, right? It's nice being able to account for interest in principal in that one. Okay, next let's get into permanent funds. Let's discuss them a little bit. Permanent funds. Remember, they are what type of a fund? Remember, there's three types of funds: governmental, proprietary, and fiduciary. Permanent is what type of fund?
It's in government.
It's a governmental fund. Yep.
But it's similar to fiduciary in a lot of ways, right? You're holding it for other people.
It can be, yeah, right. Permanent fund. It can be in a fiduciary capacity, right? Because we're holding the corpus. So, right, I see where you're going with that. Absolutely, it is a lot of similarities of a fiduciary capacity because that's why we talked about trust. Remember the difference between trust, and we're actually going to go over that one more time just to make sure we're on the same page. So. So you're right. You're absolutely right. It is a governmental type fund. Permanent fund is a governmental fund, but it does have a lot of the same characteristics of a fiduciary fund because, like I said, that corpus or principal has to be held in perpetuity, right? So permanent funds, what do they operate on? What basis of accounting?
Modified accrual.
Right. So we're worried about what? Current financial resource measurement focus. Permanent funds. The corpus of principal cannot be spent. So where is the corpus of principal with the governmental level of financial statements? How is it going to be reported in fund balance? Think about when a donor would say, I'm going to donate money to your permanent fund in your government. And I say, hey, $100,000 for scholarships. You can't touch the corpus. So where is it going to be accounted for in fund balance? Non-spendable, right? Because it's from outside, right? Outside sources. So it's non-spendable. Good job. So permanent funds. Let's see here. So let's just get into this trust. Let's see if that's the next example here. If not, then we'll just go back over. It's not going to have it. So let's just jump back here for just a second. Let's just go over this one more time. Remember the accounting for trusts. Let's just review just slightly here. If you recall, we start with the purpose of a trust. Remember, if the trust is going to be used to benefit the citizenry or government or its citizenry, sorry, I can't talk today, then it's going to be what type of fund should be used.
Or, sorry, government.
Governmental fund, right? Because why? Because it's to benefit who?
The citizens.
Or the government, right? So we know it's going to be a government fund. What's going to determine whether it's a special revenue fund or a permanent fund? It's going to be the description of the trust, but what's the description of the trust? What's going to describe
whether you can spend the corpus.
Right, whether you can spend the corpus or not. So whether it's expendable or non-expendable. If it's expendable, can we spend a corpus? If it's expendable, can we spend a corpus? Right. If it's non-expendable, we can. So if it's expendable, what type of fund do we use?
Special revenue.
Right. If it's non-expendable, we use what? Right. Awesome. So if the purpose of the trust is to benefit the government or its citizens, then we know it's a governmental fund. But we know it has to be either special revenue or permanent. And the way we know to decipher between which one we use is the description of the trust, whether it's expendable or non-expendable. Non-expendable, permanent. Expendable, special revenue. Okay. Next, if the trust is to benefit individuals, private organizations, or other governments, we need to use what type of fund?
Private trust.
Right, and that is what type of a fund? Fiduciary, right. And it's going to be private purpose trust fund. So, right, you're absolutely right. And remember, they don't have to be either non-expendable or expendable. They can be either one, but they're usually non-expendable is usually what they are. So that's just one. Again, I just want to brush this back up on accounting for trusts. So we know the difference when we use governmental or fiduciary, and if we use special revenue or permanent within governmental. So good job. So now let's look at some examples here. Let's assume that early in 2020, Richard Lee, a citizen of the village of Riverside, drove by the village cemetery and was distressed by the poor level of maintenance. So it just looks awful, right? He drove by and he's just disgusted with it. He entered into an agreement with the village officials on April 1 to provide $300,000 to the village, with the stipulation that the $300,000 be invested, the principal never expended, and the earnings be used to maintain the village cemetery. According to the Lee Cemetery Perpetual Care Fund was established, and the following entry was made. So obviously we're receiving the $300,000 from old disgruntled Richard Lee, who's upset about the cemetery's conditions. So obviously we're getting his $300,000. So we're going to debit cash, assets going up, $300,000. Credit revenues, because remember, revenues is a credit, an original credit. So revenues is going up, additions to permanent endowments, right? So that's how we know it's going to be restricted, because it's additions to permanent endowments. So once again, really pay attention to how you label what your revenue sources are, because that's going to tell us where we need to plug them on the statement, right? So we know where is this going to be reflected on the balance sheet, in fund balance. If it's from an outside donor, non-spendable, right? And within which fund, within which category? Remember, the balance sheet has major funds. General funds always major, and then other major, and then non-major. So which funds are going to be? If it's labeled fund balance non-spendable, which row is it going to be in?
Permanent.
In the permanent fund, right? Because remember, each fund balance, it's placed in the relevant fund, right? So good job. So we understand that we got his money, revenues, permanent endowments. Okay. Let's see here. So the funds were immediately invested in ABC Company bonds, which were selling at par. The bonds carried an annual interest rate of 8% and paid interest on April 1 and October 1, okay? So we got that money from him and we invested him immediately, right? Because he wanted us to invest the principal or the corpus and only use earnings to fund whatever he wanted, which was taking care of the cemetery. So obviously, once we invested in ABC bonds, we obviously paid $300,000 cash. So investment in bonds, we received the investment in bonds, right? That's an asset. So we're going to debit it, $300,000, right? That's our asset, and credit cash at $300,000 because cash is depleting now, right? It's going out the door. So now we've incurred an asset of investment in bonds at $300,000, cash $300,000, right? So we've invested that. Now, it says on October 1st, $12,000 interest was received. Remember, we receive interest payments on October 1 and April 1. So now, October 1, $12,000 interest was received. So we're going to debit cash, right? We're getting money. Cash is an asset. It's an original debit. It's going up. Revenues, remember, revenues is an original credit. That's our offsetting it to the entry. Offsetting the credit or offsetting the debit is going to be the credit to revenues. Investment income, interest. Once again, really try to be particular about what your source of revenue is. Remember, because that's going to really help when building. Because remember, revenues are reported about what? Source. So we want to know we want to be particular about what the source is. So revenues, investment income, interest. So that obviously is going to be one of the line items, make up one of the line items, whatever the total amount of interest is, and be relevant into whatever that account is when we build those statements, right? So just really pay attention to what you're labeling the revenue sources. So we received our investment, our interest income, right? Then it says during 2020, 11,000 was expended for cemetery maintenance. Remember, so this is coming out of what the interest, right? Because we can't touch the principal. So of that 12,000 interest that we just received, we're going to spend 11,000 of it now, right? So obviously, we're going to debit expenditures for the cemetery, right? Of 11,000 and credit cash of 11,000. And remember, same thing with expenditures. Expenditures are categorized by current, debt service, and capital outlay, right? And then within each of those characters, they're by function, right? So once again, remember, expenditures, symmetry. Same thing as far as sources for revenues. Be specific when you're debiting what the expenditures are, because that's what's going to help guide you to where you need to place it on your financial statement. See how the journal entries, see why I say if you know your journal entries and you can do a trial balance and make your closing entries, you can build your financials, because all you got to do is look exactly, it's telling you exactly where to place it. If you're particular about your journal entries and your closing process, see why this is 90% of the battle in building your statements. So that's why I really, really hammer down on journal entries, and be particular about where they go, because this is the telltale. This is telling where you're going to place your items on the statements when you build them. So once again, like I said, we spent this money, right? It was expended for cemetery maintenance. So we incurred an expenditure for the cemetery, remember, because it's by function. Remember, the character by function, and then the cash is leaving because we're depleting the cash. We've spent that money. Okay, modified accrual accounting requires interest revenues to be accrued at year end. So in the permanent fund, we are going to accrue interest in this one, right, at year end. Whereas debt service, we did not, remember? Debt service, the interest was accrued where? In government wide. No, remember if it was due, if the interest payment was due, like say in November 1 instead of December 31st, we would have 2 months we'd have to accrue interest for, right? But it's not accounted for in a debt service fund, it's accounted for where? Government wide. But in the permanent fund, it's saying here that we're actually going to accrue interest here, right? Right. So it says modified accrual accounting requires interest revenues be accrued at year end. The amount is $6 million. So obviously 300,000, right? That's going to be our principal. We can't touch it. It's saying we're earning it at 8%, and it's been outstanding three out of 12 months. So obviously 600,000. So if we're accruing interest, right, then obviously we're going to debit accrued interest receivable of 6,000, right? That's because that's an asset. So assets are going up. We know assets are original debit. So accrued interest receivable 6,000, credit revenues, interest income, or investment income, interest, right? Because remember, revenues are by source. So once again, we want to really be particular about the source of the money. So that's how we accrue for receivables. Same as what we've been. Same as in your for-profit. You're probably used to seeing this in your other courses. So same way, debit accrued interest receivable, credit revenues for investment income, interest. Now it says GASB section 150.105. Remember that's pulling from the codification we discussed earlier in the semester. So GASB section 150.105 of the codification requires that investments with determinable fair values be recorded at fair value. On December 31st, 2020, the ABC Company bonds had a fair value of $302,000, excluding accrued interest. So the fair value of these bonds have changed, right? So just like our for-profit sector of accounting, for commercial accounting. Remember when we have trading securities? Remember what we have either trading securities available for sale or held to maturity, or there are different bond categories. So if we have trading securities, FASB says we have to mark them to market, right? Which means they have to be stated at fair value, with the difference being reported in income from continuing operations, right? So we're marketing at the fair value. So the same thing, GASB says the same thing. If we have this investment, then they're saying we have to count for these bonds that you're in at fair value. So the same thing you're used to seeing from like your intermediate class with your trading securities and some available for sales. So in this case, the bonds appreciated in value, right? They were 300,000. Now the carrying value is 302,000. So we've actually gained in our position, right? So now we're going to debit investment bonds 2,000 because the investment actually went up now. The investment was only worth 300,000, but now it's worth 302,000, right? So therefore, because remember we have an investment account for bonds, right? The original 300,000. So if the investment went up, we have to bring that investment account up, right? Because it's an asset. So if it went up by 2,000, we have to debit investments in bonds 2,000 to account for that increase in that investment, right? So our investment account has now grew by $2,000. So debit investment in bonds 2,000, credit revenue, and then label it net increase in fair value of investments, right? Because we know assets are debits. The investment account went up 2,000, so we're debiting investments in bonds. Revenue is a credit, but we want to know the source of it. The source of it was a change in fair value. Pretty simple, right? Not bad. Okay, next it says, as of December 31st, the books were closed for the Lee Cemetery Perpetual Care Fund. So the relative journal entries we're going to see for this. Once again, it's going to be similar to the other closing entries we've seen. It's going to be the opposite of what it is during the operational period. So when we go to close them, so we know revenues is an original a credit, so we're going to debit it to close it. So debit revenues, additions to permanent endowments. Remember that the additions to permanent endowments when he made that $300,000 contribution. So now we're debiting that. Revenues, investment income, and interest. Remember we made that $18,000 in interest. Because we accrued 6,000 and we actually received 12,000, so there's the 18,000. Revenues, investment income, net increase in fair value of investments. Remember that $2,000 we accounted for. Now we're debiting that. Net increase, expenditures, cemetery. We expended $11,000 during the year, so now we're crediting that. And then fund balance of $309,000 is just credited, and that's just your plug there. Pretty simple, right? Closing is closing. I mean, you just do the complete opposite of your operational accounts of where they are, right? So we're pretty solid on the closing process there. Okay. Once again, these are going to be displayed in the financial statements from the end of the chapter, and once again, they include the chapter 4 and chapter 5 entries. So it's going to be all the governmental funds, right? Let me just see what these last two things are here. Okay, so this is going to be our trial balance, right? Before we go and actually build up whatever our statements are. We're not going to really look into it too much. And then this is going to be probably your final one here. So let's just slip back up here. So many pictures they give you, man. It's hard to keep up with. Okay, there's the trust. So this should be it right here. There we go. Can you see that okay? And that's probably a little small still. Let me see if I can do this. That help? Okay. All right, so here's our balance sheet, right? My main thing I want to do here is just to bring this, just the visual back up, because it's been a while since we've seen this. Last time we've seen this was chapter 2, right? When we went over just an overview of the different types of funds and then the relative financial statements that went along with them. So just recall here, let's just look at this balance sheet here and just look at some things that stick out. So it says Village of Riverside balance sheet, governmental funds as of December 31st, 2020. So it's balance sheet is an as of date, just like we're used to seeing. Next, we start with assets, right? Remember, it's assets plus deferred outflows of resources. And then that's going to be, on the liability side, it's going to be liabilities plus deferred inflows, remember? And then we have fund balance, which is going to be your different ones, right? So let's just look here. So that we know that's that moving down, that's the formula, right? We have assets, deferred outflows, liabilities, deferred inflows, right? But then next, remember, we have to display whether we have major funds or non-major funds. Well, the general fund is always major, right? So it's always going to have its own column. So that's why we see the general fund here. And I want to point out something here. We don't see a capital projects fund because if you recall, we finished the project before year end and transferred the residual equity and we closed it, right? So we don't have a capital projects fund column here. That's the only reason why we do not, is because it was closed. But if the capital projects was still open, if it was a longer project that would carry over into the next period, we would still have a capital projects fund here, okay? So as we can see here, we have our assets, cash, investments, receivables, and all that. And it's relative to each one of the funds, right? And then notice at the end, we have a total governmental funds column. So obviously, if we add all these up, if we sum them, there's what we got. If we see here, there's only one 302, so 302. So if we sum them left to right, right? We have the total column. Main thing is, remember, general fund is always a major column. Then you have to display other major funds, right? And then if we, in this case, there was no non-major funds. So we would, if there was, we would see a column of non-major funds, right? And that's just a compilation of all non-major funds, right? What's the test? It's the 10 and 5% rule. The assets, liabilities of both the governmental fund, 10% of that, plus 5% of the enterprise, or whatever that formula is. So it's the 10%, 5% rule. And we'll rush back up on that before we get into the exam, because that's important to know. So the 10%, 5% rule holds true for determining major fund, non-major fund, right? So here we have no non-major funds. Got our assets listed. They sum up going down this way. They sum across and going down for each relative fund, right? Next, liabilities. Obviously, we don't have any deferred outflows, so none's listed. So that's why it's irrelevant here. Next, we have liabilities, deferred inflows, and fund balances. So the liabilities, we can see we have our accounts payable and the accounts payable for each relevant fund. Once again, we sum them to the right, from left to right. Here we go. Due to other funds. So the general fund saying they have $135,000 due to another fund, and then total liabilities, right? Pretty simple, just going across. Deferred inflows of resources, we have property taxes of $40,000 being deferred inflow of resources. Why is that $40,000 a deferred inflow? What constitutes that being a deferred inflow instead of a current revenue?
Because we're expecting to receive it after 60 days.
Of the year end, right? So it's not available. So it's deferred inflow. Awesome. So if we made that journal entry, remember how we counted it as revenue when we originally levied the tax at the beginning of the year. But then if we find that it's not going to be available, we just move it from revenue to deferred inflows by debiting revenue, crediting deferred inflows. So by making that journal entry, so we just moved that 40,000 as we did, if you recall. That's why it's populating here. That credit deferred inflows, when we moved it there, that's why we populated it. Property taxes, and we know it's in the general fund because that's to account for it. It makes sense how we populate these statements like that. And then fund balance. We'll get into the fund balance because that's the only deferred inflow of resources is the property taxes relative to the general fund. So now we'll get into the fund balance. Remember, we start with non-spendable. Out of the non-spendable, remember we have a permanent fund. Principal, the $300,000 old boy just donated to us for the cemetery. We can't spend it, right? I remember I asked you where it would be on the fund. There it is, non-spendable under the cemetery perpetual care fund, which is the special or the permanent fund, right? Restricted for road repair and maintenance, we've got $237,500, which relates back to the motor fuel tax if we can remember the journal entries, but this is what it ended up being. So there it is in the motor fuel tax, and we can see here it's going over as well. So there's the only restricted assets. actually for Public Works we have one more. So for Public Works, 75,000 out of the general fund. Committed to capital projects, 100,000. Assigned for debt service, we can see 36,500 for the fire station addition. Cemetery care, 9,000. Remember, we did the 9,000 on the cemetery care entry, if you recall. And then other purposes, 50,000 just under the general. And then the unassigned fund balance, we can see where it's in what column, the general fund. Because remember, the general fund is the only fund that can have an unassigned positive fund balance. And all these numbers, like I said, that populated this balance sheet, all came from the entries we did in chapters 4 and 5. Obviously, once you've made the closing entries, you could go back and tie those amounts to wherever they relate. Just for example, like I said, the 40,000 of deferred inflows of property tax revenues, we see where it's pointed here. The 300,000 that was, the saying that we can't touch it for the permanent fund. That's why it's non-spendable right there, and the perpetual care, the cemetery perpetual care permanent fund there. So that's how you populate these. I know I'm out of time here. I still want to spend. We'll pick back up on on Wednesday. We'll start chapter 6 Wednesday. But before we do that, we'll talk a little more on this balance sheet and then talk about the statement of revenues, expenditures, and changes in fund balance that relate to chapters 4 and 5. So first part of the day, we'll finish up chapter 5. We'll wrap it up with the financial statement, spend a little more time on that, and then from that point, we'll move into chapter 6. Just remember to continue working on the Connect assignments. If anyone has any issues with anything, let me know. Like I said, we'll spend a little more time focusing on the financial statements on Wednesday so we can try to see how everything ties into everything. Everything seem okay so far? Everything all right? All right. Well, everyone just keep up the hard work, and I will see everybody on Wednesday. And once again, like I said, we'll wrap up chapter 5 and be getting into chapter 6. So everyone have a good day, and I'll see you on Wednesday.